Hello and welcome to our first investment strategy update of the year. Is the world economy on demand after the trade shock? We see three main forces at work. Activity is slowly recovering, domestic demand is holding up well, and central banks remain accommodative. With the Phase 1 trade deal, we have now moved to a new stage in US-China relations. The easing of tensions should allow for some improvement in trade flows and manufacturing activity. But while investors have welcomed the truce, trade risks have not entirely dissipated. Two-thirds of the tariff remain in place, the most complex issues are not yet covered, and nothing suggests that Phase 2 negotiations will be smooth. In fact, US-China tensions run much deeper, and the geopolitics of trade will continue to weigh on global activity. Strong rebound to above-trend growth is therefore unlikely. The recovery this year will be rather laborious. But there are some bright spots, however, driven by healthy employment, decent wage growth, and private consumption. Domestic demand is resilient, and we continue to expect this trend to continue. Finally, let's not forget that in this context of subdued recovery, central banks will continue to provide policy support. So where does all this leave investors? Well, let's turn to Stéphane to find out.
Our main investment thesis is a world of slow growth and low interest rates. This is why we are using carry strategies in our clients' portfolios. We are keeping a balanced asset allocation anchored in emerging market debt, global high yield, and real estate. However, the main risk, trade, is here to stay, as Sami just reminded us, and the cycle is maturing. Portfolio must be resilient and well diversified at all times. There are many reasons to be agile, and recent tensions between the US and Iran provided a very concrete example of this. Both oil and gold overreacted, mirroring the instability in the region. However, investors' risk appetite held up well and was hardly affected. This was an opportune time to take profits in US dollar portfolios, and we substituted gold for US treasuries, which can provide both yield and portfolio protection. It's a very different dynamic for non-US dollar portfolios. Negatively yielding euro and Swiss franc government bonds do not offer any income advantage over gold, which is why we decided to hold onto our gold position in these accounts. In addition, for Swiss franc accounts, we shifted some exposure from Swiss real estate to European real estate to bring greater geographic and sector diversification to our clients and lock in some profits. In FX markets, we have turned neutral on sterling. We remain constructive on the euro and emerging market currencies against the US dollar, and we are monitoring them for potential entry levels. One of the most immediate concerns for market is the coronavirus outbreak in China and its potential to disrupt the world's second-largest economy. Investors will also focus on a number of other key themes set to shape markets this year. President Trump's impeachment trial, Democratic primaries from February through June, and of course, November US presidential elections. Looking further ahead, powerful structural forces are reshaping the world of investment. Shifting geopolitics, social discontent, growing inequalities, and climate change. Most are risk to financial stability, and central banks are starting to analyze the potential consequences. We are also paying close attention to these longer-term issues. Thank you very much for watching.